Yeah, this is far better. Yeah, thanks.
Okay.
Hi all, we are live.
Okay.
We can start now.
Sure. Good evening, everyone. And first of all, thanks a lot for taking out time to hear this call. This is Abhishek Mehrotra, Head of Investment Products. And today we are here for a very interesting topic. But before we jump on to what we want to discuss, I'll quickly introduce our guest. So we have Mr. Vikram Dhawan, who is the fund manager with Nippon India AMC. And gold is something which he's taking care of, and he has a long history about managing gold. So welcome, Mr. Vikram.
Thanks for inviting me on your show. Thanks.
Uh, Thank you. And then second guest of ours is Mr. Sandeep Chavaria. He leads the passive business with HDFC Asset Management Company, our group company. And welcome, Sandeep.
Thank you, Abhishek.
Though you talk about all passives, but today we'll restrict you to silver only. That's the context of the day. And
Yes.
then we have Devarsh Vakil. Devarsh, we can't see you. So Devarsh Vakil is head of
Are you
research of
able to
HDFC
hear me?
Securities. Sorry, I
Yeah, Abhishek, are you able to hear me?
yeah, we are able to hear you, but can't see you. Yeah, yes, now we can see you also. Thank you. Great. So so quickly jumping to the topic, knowing the time is of essence to everyone. Last 1 year has been fabulous for at least the glittering metals, which is gold and silver. Silver taking the lead, almost 74% up in 1 year. Gold not too far behind, 55%, but the latest catch up has been done by silver. And then we are talking about Nifty, which is around a single digit or lower single digit returns of 1 to 3%. Uh, but that has been the past. I How I want to take this session is to all of our viewers is what they want to have this 1 year forward, what they look forward to. So probably I'll start with silver, the who is so far the lead runner in last 1 year. So over to you, Sandeep. What we want to know or what our clients will look forward to hear from you is what has fueled this rally of last 1 year, where we stand now, and how do you see next 12 months for silver going forward? Over to
Yeah,
you, Sandeep.
thanks, Abhishek. Yeah, so silver has had a dream run, as you have mentioned, in last 6 months to 1 year. Prior to that, gold was the one which was leading the rally, and gold still is in a new lifetime high of $4,200 an ounce. So silver in the past has touched this $50 an ounce level only in 1980 and 2011. And it's been a while since this level has been breached. It's, I think, currently slightly above $50, around $51, $52 an ounce. And in the past, silver has retracted from these levels, but something has changed in the intervening period. As you know, silver is a precious metal, just like gold. It is also quoted in dollars, so it has the properties of a diversification or safe haven. But in addition to that, it also has industrial demand usage, and it is used extensively in the green energy. So the green energy thrust has been there since the Paris Accord for a lot of countries. So a lot of countries are investing in generating green energy through solar power, and then even you have these vehicles, ICE vehicles are now facing competition from electric vehicles. So silver is used in electric vehicle batteries, in solar, what you call panels. So the industrial demand for silver is pretty robust. It has grown with time and it is projected to grow. This growth is expected to sustain in the future years, next 4 5 years as well. And that is something which is keeping silver in demand on the industrial side. And there is a gold silver ratio, which is a very common metric, which is followed by most investors while investing in silver, because gold is the leader. And the gold silver ratio indicates to you how many times more dear gold is as compared to silver. So the current
Right.
ratio, if you take like $4,200 and you take $51, it's roughly slightly above 80 times. And it has been, if you see the long-term 15-20 year average, that has been around 70 times or between 70 and 80 times. So whenever this ratio goes to 100 or it goes beyond this level, then silver plays a catch-up rally. And this is what has happened in the last 8 9 months, where gold went up first. Silver had was moving in tandem with gold, but then it had started correcting sharply. But now silver has caught up big time with gold, so you have seen this rally. Uh, as far as the outlook for silver is there, it is pretty positive from a long-term point of view. There are a lot of reports that if this technical level of $50 is broken decisively, there could be new highs for silver in the future. But what I would advise investors is that the return expectation cannot be the same where you have 1 year where you have 70 or 80% kind of returns. The next year cannot again be 70, 80% kind of returns. But
Right.
definitely the trajectory for both gold and silver, gold, of course, Vikram will cover what are the reasons for the drivers of demand. But silver, to some extent, the rally also derives its value from the appreciation in gold. So this has been coupled with equity markets not doing that well in India. In US, it is a little different. Their equity markets have also done well. So there's a bit of
Right.
divergence in the precious metals as compared to equities in India than what is the case with US or Europe. Those markets have done better than India currently for whatever reasons.
Sure.
But this rally is sustainable. There can be bouts of correction. Silver's volatility is more than gold. Gold does not fall as sharply as silver, but I think it has won the attention of the investors, and there still is.
Yes, yes, Sandeep, we'll come to that. Somebody, if I was about to enter the call, somebody said Chandi bahut chanchal hai, it cannot remain in the hands of investors. So we will discuss that little more in detail. I'll quickly move to Mr. Vikram. Your view about how the gold is performed. Obviously, we know 50% up, but your views why it has happened and what are your observation in terms of the key drivers on that?
Sure. So Abhishek, I'll just add to what you said that gold has been the best performing asset for the past 1 year or whatever. I think gold has been the best performing asset of the century so far. If you look at the returns of past 25
I agree.
years,
Yes.
it has exceeded the returns of the US stock market also, which is not a mean feat considering the AI and tech and whatever is happening. So that tells you a story about what gold has done in the past 25 years.
Right.
Also, if you look at the various economic crises or black swan events which have happened in this year, right from GFC to COVID and Ukrainian war, gold has performed in all of them. The degrees would have varied. Sometime it has performed better or worse than its previous, but it has always given positive returns in US dollar terms. Also, on the past 25-year data, if again, this is all past data, it doesn't guarantee you that this will happen. If you would have added 5 to 10 or 15% of gold to your 60-40 portfolio, not only your aggregate returns would have gone up, your standard deviation of the portfolio would have come down. So I think it's a very formidable track record to ignore. The track record itself is propelled a lot of serious players into this market. But again, the central banks have been diversifying into gold for now quite some time. It may appear through social media this is a recent event, but as a fund house, we discovered abnormal central bank activity way back in 2017 and 16. When the Chinese and the Russian central bank were buying. And typically they buy about 400 tons per year, but that year they bought 2017, they bought about 700, 800 tons. Fast forward to the last 2-3 years, against a long-term average of 400 tons, they have been buying in excess of 1,000 tons. Even this year also, they have H1, they have bought in excess of 400 tons. So central banks have been the main driver, the main linchpin of this rally. But what has also happened is that we are in the middle of a global asset allocation reset. What started with the central banks diversifying, and maybe we used to humor ourselves that maybe central banks are not doing the right thing, but that is now from central bank, the asset allocation global reset has moved into Main Street. And since last year, when the managed money was underweight on gold to zero allocation to precious metals, we are now moving towards some sort of an allocation. Everybody wants precious metals in their portfolio, and that is what is being manifested. That has been what you're seeing on the screen. We may humor ourselves with any fundamental technical macro analysis. Till the time this reset continues, you will see this kind of a market. I don't know till how long this reset occurs, 1 year, 1 month, but this is something which is driving the prices. I can explain it with some factors, saying that whether it is the fear of the dollar or debt, but fact of the matter is that investors are convinced that they need exposure to it.
Right, right. So, Devarsh, now coming to you, uh, the most loved boy for the Indian markets, which was Indian equities, which has taken a seat back, and now the metals have taken over. What has impacted the performance in last 1 year, and a little some light, what are the key factors which has brought it down, and how you see market now?
Right. So I agree with my other two gentlemen on the panel that gold and silver has taken a limelight recently, but there are many years where gold and silver has underperformed the equity markets, and equity has been a sort of a all-weather investing asset for investors, whether it is 10-year, 20-year period which we see. So the coming to the reasons why we have rather Nifty has underperformed or the Indian market has underperformed, uh, it was because the from the COVID lows, the markets had gone up ahead of its fundamental. The 4-year returns were fantastic, so it was natural for market to consolidate for a year. And in fact, if you remember, Abhishek, did write it in our last year's somewhat 2081 note that the investors should temper their expectations from equities because markets have given fantastic recent returns last year. Coupled with the higher valuations, we saw geopolitical uncertainties, uh, Russia, Ukraine, Gaza, Israel, and also skirmishes with our own neighbor in our own background. We saw a lot of geopolitical uncertainty. So that led to some kind of uncertainty. And on top of it, though India was the first to start negotiation with the US, we haven't been able to do a trade deal with the US, and the imposition of tariffs on our country, first 25% and then they ratcheted up to 50%. So these are some of the reasons why we did not have the earnings growth which was expected from the market. And since we had a single digit earning growth, we see that the Nifty returns are also subpar 4-5% over the last somewhat. Uh, Coming to the expectation from the next somewhat, I think most of these the concerns which were there have started receding. So valuations, because we have underperformed, the earnings have grown up, and we are expecting about double-digit growth in FY27. So valuation-wise, we have become a little more attractive. The consistent or the incessant outflows which we were seeing from the foreign institutional investors, there we are seeing the signs of getting abated. The relative valuation of Indian equities, especially the MSCI India index compared to the other MSCI emerging market index, we were trading at 80% kind of a premium. Now we are coming back to around long-term averages of around 50% premium. So valuation wise, we are now back into the range. And as I explained, we are expecting good growth on the back of whole host of factors. The liquidity given by the RBI, the rate cuts, the CRR cut, the government on the fiscal side, they have given the interest rate, the income tax cut, and now the latest GST2 reforms. So all this makes me expect that the earnings growth will come back, and on back of it, we will have good growth in the Nifty. And as we have seen that if you are managed to pick good stocks, then obviously stocks have given much better return than Nifty. So I'm looking forward to a good, healthy returns from market as well as some select stocks pick this year.
Great, great, Devarsh. So I think as for you, the desk is settled on the equity side. Probably this could be the end of earnings downgrade. That is what you are sensing. I will, Sandeep. Now I'll come straight away to you because on volatility, silver is giving everybody's jitters in terms of the way it is moving in last 2 weeks or probably last 1 week has been really volatile. 5% up, 5% down. ETF prices. Now, let's talk specific to ETF prices. So there are two things which market is hearing. And first of all, the fund of funds, a lot of AMCs have stopped taking fresh subscriptions on fund of fund. So that is one which probably you want to address everyone that why fund of funds fresh subscription has been stopped for most of the AMCs. That is one. Second, the correlation or between the spot prices on ETF or sorry on silver and the ETF, there is a lot of variation. So how is this derived? How is why there's so much anomaly in the system now?
Yeah, so I think this particular point that you have raised has been in the press for the
Yeah,
last 1 week,
right.
and we have also taken measures of temporarily suspending transactions above 1 lakh rupees in a silver ETF fund of fund.
Right.
The silver ETF fund of fund basically buys the silver ETF units. That is the
Okay.
main job of the fund of fund.
Right.
And what happens is that when the investor is investing in the silver ETF fund of fund, the NAV gets decided on the last traded price on the exchange of the underlying ETF. So what had happened temporarily for a couple of days, we had seen there was a premium which was quoting as compared to the INAV or the indicative NAV, which is what you call displayed for the ETFs. And this was because there was a premium in the physical market, which was being demanded by the bullion dealers and the jewelers, because the Diwali, Dhanteras time is there, the festive buying is there. So there was a lot of demand from the physical side as well as there was demand on the investment side from the ETFs. So when we have to do a unit creation for the ETF, that has to be necessarily backed by physical silver. So there was a temporary time when the shipments, that's what we were given to believe by the market makers, that the supply was catching up with the demand because the demand had risen sharply. And as the shipments came, this what you call premium that they were demanding sort of cooled off. So why most AMCs did this temporary suspension was that they did not want unit holders to enter at a higher price at a premium, and as soon as that premium would disappear, then it would be a loss to them. So to prevent this anomaly between international prices and domestic prices, which was there, this measure was taken. And it is the discretion of the mutual fund or AMC to remove this suspension as and when they believe that this normalcy is resumed. We can see in last 2 days actually that those premiums have come down significantly. And today there are some small discounts of the ETF quoted price to the intrinsic value of the ETF basket. So the spot price of MCX is taken into account to arrive at the value of the basket. And if at all there is a premium which is being quoted by people who are selling that ETF, then this pricing mismatch was there. So it's a temporary phenomenon. This should settle very shortly, as we can see over yesterday and today. It has settled in a very large way. So I think maybe there was a confluence of demand on the physical side as well as on the investment side, which led to this temporary misalignment in the pricing. So that has
So one
kind
is,
of
Sandeep, one is why you are saying fund of funds have stopped taking fresh subscriptions. So, okay, that you clarified. But what explains the ETF, premium versus the spot rate? and the say bullion rate. There's a huge amount of divergence between multiple ETFs and the bullion rate.
So there were a couple of days where that premium was 4-5%, which has
Right.
come off. But again, it is the people who are holding on to the ETF. So because they perceive that buying, I mean, anecdotally, what you read in the press was that physical silver, which is available at a jeweler, is still quoting at 1,85,000, 1,90,000 for 1 kilo, whereas the current spot price, which MCX releases, was around between 1,65,000 to 1,70,000, and this was 1,75,000 yesterday. So that's why people were trying to see if the ETF is cheaper, go buy the ETF, and then that started quoting at a premium, so that between the physical price and the ETF price, again, there was a convergence. So now all those things are because AMC's put a halt to the FOF lump sum investments, that demand for the ETFs came off. So that's why the pricing is coming more in line with the underlying spot prices which MCX releases. So that mismatch has been addressed because of this suspension of subscriptions, which was undertaken by nearly, I think, 60-70% of the AMCs, which were offering the fund of fund. So that has kind of been addressed. The other factors which are there in the bullion market, that may also be a festive time, that Dhanteras, Diwali, people like buying precious metals, and because gold has become very expensive, so maybe a lot of jewelers were saying that silver is giving you similar kind of return, why not buy silver, because you can do it with a smaller amount as compared with gold. So that would be driving the physical demand, so to speak. So these I think mispricing will not last that long, we can see that. And
so you are in the camp that the dust is settled here also, and probably the volatility which we have seen in last, say, 5 to 7 days, it was an anomaly, and it has been addressed, and way forward probably the variance will be limited.
Yeah, so
to a larger
previously the
extent.
demand was outstripping the supply. Now a lot of supply also has come, both of ETF units and maybe physical silver as well. So some cooling off has happened of that frenzy that what we had seen last week.
Okay. So, Mr. Vikram, what since you manage metals very closely and you have a view in terms of what Sandeep said during the start of the discussion, that it was a catch-up story for silver because the varies between the gold and silver has gone beyond the long-term averages. Where do you see gold running now, and probably that will pull silver also, or first of all, gold? Where do you see gold running now? Because we are almost we are ahead of $4,000 per ounce, and things are not stopping.
I wish I had the answer. I would have done the
But
needful.
key factors which can which can probably stabilize it in your opinion, what could be? Look, uh, uncertainty from the US is something which is given now. Everybody is knowing that it also depends on which side Mr. Trump wakes up and things really moves that way. So, but apart from that, the central bank buying, which is the core reason why, as per you, the gold prices have gone up. Will there be any pause, or will that continue to be as, or which will further aggravate over the period of time? What's your opinion?
So Abhishek, the main worry in the gold market was of demand destruction, because on the physical market, because obviously, couple of months back, if you would have asked me that what kind of demand you can expect in the Indian market, I would have said, obviously the prices are higher. Prices have moved up by 40-50%. Not everybody's disposable income has gone up to that extent. But again, let me not wrong foot everybody. But so far, what we are hearing from the ground, again, it is very, very anecdotal. I don't know where the needle stops. So far, it will not be a surprise. It turns out to be another record season for gold, which means the only shoe we were expecting to fall off, the physical retail demand, so far it has not fallen off. Then we have the Chinese season coming up in Feb. Will we see similar sort of demand from the Chinese also? It remains to be seen because this was the only Achilles heel of the gold market. Investors are convinced, central bankers are convinced, there are enough events happening, and thanks to the Americans, we have enough to worry about each day. Well, we have our own problems also, so let me not blame them for all the problems. But so far the demand destruction has not manifested. That doesn't mean that we need to become absolutely bullish because, again, statistically, we are in an uncharted territory in gold. And I think some sort of correction is possible to going towards the end of the year. Again, it can play in two ways. The investors are sitting on large profits on gold, and typically, like the FIs, they may have to decide whether they want to take some money off the table before the end of November. So you could see some profit taking happening. It's an if, right? But the flip side is if the profit taking doesn't happen by end of November, we'll be moving into December where the volatility is thin. You could see some spikes happening. The mind tells me a correction, the heart tells me no correction. So I don't know which one is right, but I think the probability of that correction happening or consolidation happening is rising, is a lot more higher than it was a few months back.
Got it. So between heart and the mind, since mind is above heart, so probably we can just go with that. That's the only logic which we can apply. So Devarsh, now since we are discussing gold, like what are you hearing, or probably you have any sense from the people who are into gold jewelry, because their volumes have gone up. What I was hearing was probably volume has gone up because of the prices, but not in terms of grammages of sales. So probably are they selling the same grams or same kgs of sales which they were doing last year, or probably it's just an outcome of the volume and the sales actually in grammages or in kgs have gone down from the jewelers. Uh, what are you hearing, Devarsh?
Yeah, so the commentaries which we are reading from the jewelers is that the grammages wise, the value has gone up. Obviously, so the business turnover wise, they are okay, but the grammages are down. At the end of it, as Vikram pointed out, the disposable income has not gone up. And traditionally, the retail investors, the retail consumers always take a time to adjust to the prices. So in my experience, I've seen that whenever we see such step function rises in gold, it takes a certain amount of time for retail buyers to adjust to the new prices. The first response is always from the um, investors or the short-term traders to come to the market and offer their physical supply. And then once the prices settle down, the jewelry demand picks up. The second point, Abhishek, I would like to point out is that as both the gentlemen pointed out, that at the end of the day, gold and silver are a play on uncertainty, and uncertainty do not last forever. We have seen that such another period of such in 1979, 1970, 1980, where certain same kind of 150, 200% move in gold, silver we saw, and it took almost 26 years to come back to those same prices again in the dollar terms. Because rupee depreciates against the dollar, it took about 25 years in uh, rupee term to come to the same prices. So there are
Right.
a couple of years where they do fantastically well, but then there will be a years of consolidation. And like we say, investors should not just buy it because there is a fear of missing out and allocate disproportionately to gold, silver right now because the
Right.
prices are moving and we are hearing about it in the social media. Obviously, as we have been allocating, we are giving our investors asset allocation advice. So obviously, certain portion of your portfolio, depending upon your risk appetite, should be allocated to gold, silver. But
So
I
Indian
think
Indian mothers, they were smarter than the US mothers who are holding gold, because the
well,
returns of Indian
Indian
mothers were higher compared to US mothers, right?
and because the Indian women has been holding so much gold, I think the now the holding has reached to even as high as our GDP. So that way, India, we used to say that India is a compared to Western world a poor country, but because of this gold holding now, we can say that our housewives and our women have actually a asset which is actually a store of value. So going back
Right.
to theory, the gold is not only the earlier it was used for the exchange, but now it is a store of value, and certain financial uncertainty brings that point out that it has remained a store of value for years together. So
So
gold and
Devarsh,
silver has
also talking about stock specific, approaches towards next 365 days or next 1 year. So I believe you have come up with your Diwali picks also. So tell us a bit about it and how you see probably. So we have discussed past, obviously, but what is there in future, or what is your view? As you said, probably earnings downgrades are somewhat stabilizing. Probably we are seeing a better valuation compared to what we were seeing same time last year. Uh, FIs have sold enough, or will there be more selling? And a bit on your own, what have you handpicked in terms of 10 scripts which are there? So quickly, if you can talk about it.
yeah, sure. Abhishek, quickly, I want to talk about two things. We have talked about Nifty, gold and silver, but also there is a case for doing an SIP Nifty 50. So let me spend 1 or 2 minutes just on Nifty
Sure.
50. That is also one of the uh, areas where we want to dwell. So as we know,
Yes.
Nifty 50 is a well diversified ETF. 50, one of the largest company, they cover about 55% of the market. So more or less, you are covering half of the market if you buy those buy Nifty ETF. It has well balanced. It has IT, it has finance, and it is governed by the index committee. So if some companies doesn't do well, eventually those companies are chucked out, and newer and gooder companies are actually brought into the Nifty. And it is one of the indices where you can do the rupee cost averaging, do averaging, because if it goes down, as long as India is going to grow, as long as the GDP is going to grow, we expect 50 top 50 companies profits to grow, and that means eventually Nifty will be able to beat those earlier levels. So it is one of the easy low hanging fruit for investors to generate wealth via financial instruments. So if you don't want to pick stocks, I think Nifty SIP is a good long way to generate wealth. Now, if you want to pick stocks, and as it is a tradition that every summer we do come out with our Diwali picks, so this time also we have issued 10 stocks, Abhishek. As We expect that the stock specific uh, stock picking will give us returns this year. So our focus has been the consumption oriented. Our predilection towards the domestic consumption remains this year also. So we have chosen 4 stocks out of 10 into consumption side, and some stocks from the finance, power, and the engineering side. So I'll quickly just rattle off 10 names if you permit me. So alcohol, associated alcohol, Bharti Airtel, Happy Forging, IDFC First Bank, JSW Energy, Larsen and Toubro, MSTC Limited, Northern Arc Capital, Pidilite, and Sheila Foam. These 10 stocks, which we have created a basket, and we have given a name as a somewhat 2082 basket, and issued. So the idea behind them is that a mix of few large mega caps and some small cap and mid cap stocks where there is potential to give higher returns to our investors. Balanced basket we have tried to create where we expect that over the next 1 year, uh, given the opportunity available in the stock market, they would generate superior returns for our investors.
Great, great. And in fact, investors, if they want, they can buy the same basket on via MTF through the Bali MTF basket. So yes, that is so. So investor don't have to remember the name. They need to remember the basket that yes, somewhat 2082 or MTF basket of HSL is available, and then these ideas are there. Sandeep, now quickly coming to you. like as we are talking about way forward in silver. So what will you do if you have $100 to invest? Will you do a lump sum in silver or you'll do an SIP in silver?
Uh, uh, I think because it is volatile in its price movement in comparison with gold as a precious metal, it is suited for SIP. And keeping
Right.
in mind that the run-up has been pretty sharp, but the underlying factors for demand have not changed materially, both for gold and silver. A better approach would be to do a SIP to invest into silver. I think that would definitely pay off. And for people who prefer lump sum, then they can wait for that correction which they were looking forward to and which has not materialized in last 1 2 months. It has been one way.
Right.
They can probably keep buying on dips. But SIP would be well suited to silver because there would be some kind of volatility whenever these trade tensions ease off. There is some semblance of the US, whatever they have, this government shutdown and other problems that they are facing, and they regain the trust of the world. If there's some pushback from their government in aligning with other countries, then maybe gold might cool off, and then silver might also correct a bit more than gold, what generally has been the trend in so many years that we have seen. Then you can opportunistically add. But I think one thing which I know, even from my personal experience, our allocation to gold and silver as an investment in our portfolio is very negligible. People talk about 5 to 15% allocation to both metals. Generally,
Right.
most people must be hardly 1% invested in either of these asset classes. So I think SIP is a good way to gradually build up your allocation to between 5 and 15%. Even Morgan Stanley had spoken about that was more for gold, that instead of the traditional 60-40 allocation to equity and bonds, you can look at 60-20-20 in bonds, gold, and what do you call equities,
Okay.
bonds, and gold. So I think silver and gold as a combination, one can build up the allocation to 10% at least in their portfolio. It can give you a good insurance when you have times like these when the equity markets for whatever reason are not performing because the earnings momentum has slowed down or the valuations look pricey. Those things keep changing. So I think
Sure.
SIP from this point of time definitely looks the better approach.
Great. And since you're saying out of $100, if you have, you will put and do an SIP. What will be your allocation since you manage gold also, and being head of passives, you have a deep understanding of other ETFs, which is Nifty and Nifty Next and all. So probably can you give your split in terms of if you have to invest 100 rupees now, how will you put it across between gold, silver, and Indian equity markets?
So my ideal allocation right now, so we've come off a time correction in Nifty, as even Devarsh was mentioning that for a multiple reasons of slowdown in economic growth and corporate earnings growth, the Nifty didn't perform to that extent. And globally, if you see equity markets have performed wherever AI has been a big story, whether it's US, whether it's Korea, whether it's Taiwan, whether it's China. So India has been underweight on AI. So we've not had that bubble-like valuation. We had some overvaluation compared to our historic averages. So that has kind of now come off, and government of India has taken a lot of measures to pump up the demand again. And banks and IT, which are very high, what you call allocation sectors in our markets, have not done that well in the last 2 to 3 years. So I think you can put 70 rupees in equity. You can put 20 rupees in gold and 10 rupees in silver. I think that could be the ideal allocation that I would look at from a personal
Great,
point of
great,
view
great.
also.
And yeah. So I think to summarize what you said, though the demand of silver remains intact, industrial demand, green energy, and all, but probably it's time to accumulate silver rather than jumping on with a larger sum immediately. And if somebody wants to put across a larger sum of money in silver, probably he can wait and watch. There could be an opportunity coming. Obviously, this is coming just because of your guide. You can't foresee any correction. And so, Mr. Vikram, coming to you, since you also have a strong background across the financial markets and all, how do you probably the first same question to you, $100 if you have, do you invest right away to gold or do an SIP, or how will you approach?
So I think the first question is whether it should be $100 or €100. Would you like to hold everything in dollars? That's the question. I think Sandeep made a very valid point. While we have been having these products for a very long time, but still the Indian investors are grossly underinvested in precious metals. I mean, you look at the AUM of gold and silver ETF, it's not even 2% of the total. I mean, don't count the jewelry and the physical bars in your safe. That's not part of your capital market portfolio.
Right.
But I think at the same time, I would refrain from giving a particular range. What I would rather, like to discuss is that each portfolio is different. With regards to gold, you need more gold if you are skewed more towards risk assets. I mean, Devarsh will not will agree, but equity is defined as risk asset. So, and or maybe credit, low grade credit, whatever is higher the allocation to risk, the higher the allocation to gold. In a portfolio which is skewed towards fixed income or less, their gold, obviously credit risk is something which is, we don't expect the central banks to blow up anytime soon. I mean, could be my last famous word and tomorrow something happens. But there, I think gold is a combination of bumping up the returns and also providing some protection. But I think the least denominator is that what is that part of your portfolio you always want it to be liquid, irrespective of what is happening. And that has to be a combination of short-term debt and gold. Now, whether that is 50-50 or 40-50, you can take a call again. But I think this is something which is the minimum. Also, just see the volatility of your portfolio. And that will also decide how much gold to hold. And volatility along with what has been statistically shown as the cycle of risk assets in terms of correction, 3 years, 4 years. So that gives you an idea of what is the minimum and maximum to hold.
Got it. So, Vikram, do you believe that the volatility of gold will remain as it was in past? Because past was a different price. Now we are talking about 4,000 plus kind of a dollar per ounce. The volatility will obviously will jump in when the prices go up. What's your view on that?
So each bull run is different. Let me not go too much back, but the previous bull run was completely driven by ETF flows. The one from the 2007 till 2011-12. If you see the ETF flows, you see the gold price, there was very strong correlation. No central banks. Central banks were in fact selling. This is a more broad, this bull run has got broader participation. It's got central banks, it's got investors, it's got, asset allocation, portfolio, all those things. But yes, nothing can go up in straight line. Although it has been going up in straight line in the past few days and few years. But the fact of the matter is that, you have to take each era differently. But yes, the point Devesh mentioned that you should also look at the history and see what is the worst case scenario you can digest your stomach.
So any floor price, Vikram, which you have in your mind that say $3,700 per ounce is the price where I'll go all in. I think that's the floor where gold can fall up to. So probably our investors will get a broader range. Obviously, you can be. This is just a back of the envelope kind of a number. I am not putting any specific figure in your mind, but just wanted to have your view around that.
So obviously, as a mandate, we can't give you price levels. But I think what is very important to understand is that where the physical demand we have seen, which has come maximum, and that you'll have to see whenever the price corrects, with whatever that level is. That becomes your, because ETF will sell. ETF selling, buying is momentum and selling is momentum. They will distort the market on the way up and way down. So unfortunately, I am not authorized to give you any price. But the way I will look at it, I will see the flows and then take a decision.
Okay, so if I may sum it, or probably if I may be wrong, but to investors, probably there could be volatility or more volatility in gold. But as far as the demand continues, probably the acute volatility which people may fear may not be there till the time demand is there from central banks. So that is what Vikram is hinting. Though industrial demand for gold and silver both will keep on continuing and keep on growing, but that's not the only thing which is driving the prices right away. It's more on the uncertainty part. If I have summed it well, I hope. Now, Devarsh, coming last to you.
Yeah.
Now, one year we have seen Nifty just playing a laggard among the two metals. In terms of allocation, how 100 rupees given to you, will you go all out in Nifty, 100 rupees right away investing, or you will also take an SIP approach?
No, I will take an SIP approach. So, answering Vikram's point that no, we do think that equities are risky assets. So, if you are in the wrong stock, you may go down 50, 70%, and we have seen in the past. So, depending upon the risk, your risk appetite, we should do the allocation towards equity. That is very clear. Now, once you've decided that you want to allocate X percentage of amount out of your portfolio to equity, I would say we will do SIP. And in fact, it's not only Nifty or the equities. We as a brokerage, we have been recommending that depending upon your risk appetite, you should put 10 to 15% into uh, gold and silver ETFs, and we have been recommending it throughout the year. So maybe 10% into gold, silver. And remaining into other ETFs, if you are doing a ETF portfolio, just like what we discussed yesterday, Abhishek said, maybe 50% of my capital, we will put it into Nifty, Junior Bs or the next Nifty, where we will put another 25% and
Right.
10% into bank Bs and another remaining portion into the bullion ETFs. So that I think would be in the allocation according to me. And why I'm giving more allocation to Nifty is as we have noticed that the underperformance usually mean revert to a better performance. So last 12 to 18 months underperformance should give to some good performance in next 12 to 18 months, and that's where we are recommending higher allocation towards Nifty.
Okay, so I think there's a question. So I'll probably take it up. I think it's more guided towards Vikram, as it talks about that central bank have probably taken a pause in terms of buying after 2023, and it's primarily driven by investors. So, Vikram, I don't know whether you can see the question or not, but your views on it.
Well, I don't know what pause is suggested, because in H1 central banks bought 400 tons of gold, and last year they bought 500, 600 tons. Yes, there is a dialing down, but 400 tons is definitely not a pause. So yes, I mean, they're very canny operators. Central banks are very canny operators, and they like to buy at dips. So they will refrain. They will wait for corrections to buy, because they are the whales in the market, right? So they are the ones who provide the floor to the prices. So they're not in a hurry to load up. But yeah, I mean, in these prices, 50% up, they still bought 400 tons, which says something.
Okay, so there's one
Abhishek,
question related
if
to
I can
oil.
come in here.
If
Sorry,
Yeah,
uh,
sorry.
so uh, Abhishek, can I come in here?
yeah,
So
please, Devarsh.
one thing which has changed, and I think we haven't discussed, is that the mandate from the central banks and the governments across the countries to look at their reserves other than in the dollar, and what happened with the Russian reserves and freezing of these assets has flipped the switch. So when we see the history of gold, or when we see the performance, I think we should also keep that point in mind, that we will not see those kind of drawdowns in gold now, because the de-dollarization theme, as long as the current administration or the current policies of the US government is like this, we should not expect that the gold will behave the way it used to behave, because now it is more of a store of a value features which are coming in, and certain compared to the large amount of reserves which are there in the dollar, physical availability of gold in the market is minuscule. So when there is so much demand from central bankers to move away from from dollar at lower level. Whenever the correction comes, there will be central banks which will be buyer, and that's answers to the question which the investor asked, that I would bet my money that at lower level they would come in and do the buying there and provide some flow to the market.
Great, great, great. I think uh, there are no further questions. One or few to our stock related. I will avoid that. Uh, so, uh, lastly, Vikramji, this is between US debt versus gold prices. Do you think they both will go move in tandem? That is one thing which has again come up. Yeah.
So I was dreading you would ask me this question because it's Diwali spirit. I don't want to dampen it. See, the global sovereign debt today is $105 trillion. The global overall debt, which includes private corporate, is $350 trillion. You are paying an interest of $3 to $4 trillion per year on sovereign debt. You're paying an interest of $8 to $9 trillion on the overall debt. This debt is, as per the Bloomberg forecast, is expected to double, not in absolute term, in debt to GDP ratio term, in the next 10-20 years, which means this 100 trillion will become 400 trillion 10 to 20 years down the line. So we have a debt problem. When that reckoning happens, again, it's not right now. Please don't take my word, take it the other way around. We don't have a debt crisis right now. But this is what the central banks are doing. And there was a survey conducted by World Gold Council some time back, in which almost 45% to 50% of the central bank, the main top concerns was unsustainable debt load in the world. So what is the antidote for debt? It is gold. Gold doesn't have a credit risk, right? So this is the motivation for this. So yes, debt is an issue. It's not a crisis as of now, but it is something which is pretty much on the radar of a lot of serious people. With regards to US debt, unfortunately, it is not just US. Despite this issue, US interest rate burden is about $1.3 trillion per year. They're trying to bridge the gap through the tariff. But the issue is that nobody is thinking of or saying about reducing the debt. It is debt and more debt.
Good.
So I'm sorry if I sound a bit pessimistic because I have a gold fund to sell. So,
Hey.
so don't take my word for
So
granted.
that's the world around. So you can't change just because you want to sound sweet. It has to be the reality itself. That's why we have called guests like you who can come straight away. So last question again, which is on ETF prices, Sandeep, is about the spread and the comfort. So I think there are a lot of questions on that on YouTube. So simple answer which Sandeep has already spoken about is that yes, there was an anomaly. There was a lot of variance. There was a lot of volatility which has been addressed, and probably way forward, there will not be that much kind of a variation between the gold prices and the silver prices, gold or silver prices both, and the ETF. So one should just exclude that, and way forward looking to the future, you can believe that the variance will be limited. I'll quickly summarize whatever we have discussed on the silver. Yes, it's a precious metal, a lot of industrial use. One should keep on accumulating, but the kind of rally which we have seen in last 12 months may not sustain, and one should look ahead for accumulating in a SIP model or a staggered manner rather than jumping one shot. As far as gold is concerned, what I could make out with Mr. Vikram's discussion, there could be some volatility which may come up. That could be profit booking. But yes, this is the only precious metal which is being held across central banks, and they will continue to have their love for this metal till the time there is debt. And since debt is not going anywhere, probably this love will remain and keep on growing gradually. There could be some spikes, but that's where Mr. Vikram is putting his stance. In terms of accumulation, yes, probably one can keep on accumulating. There's nothing to jump right away on a casual or a gradual accumulation, and definitely a larger a larger pie from the overall portfolio, because what has been spoken by all three gentlemen, one thing is common, that one should allocate at least 10 to 15% if you're looking for lesser volatility in the portfolio. Probably gold can be one of another cushion which can which can go against equity market and definitely give you that support. Lastly, Devarsh has anyways talk about stock picking. He's positive about broadly the Indian markets, but yes, volatility will be part of the game. And yes, he has come up with 10 stock ideas, which he believes are the best thing to invest in for. And there one can definitely go in for lump sum. You can buy the basket, you can buy it on margin facility also, or you can do your pick and choose the entire. This is available. Thank you, gentlemen. Thanks all for your time. And I think we are just 1 hour. We are done with this call, and we'll look forward to hear from you again. Thank you, everyone.
Thanks.
Thank you
Thank
very
you.
much.
Thank you, everyone.
And all
Thank
the
you.
best and happy Diwali to everybody.
Same to
Happy
you.
Diwali.
Same to all the viewers. Yeah, definitely. Same to all the viewers who are listening to us or hearing this. Thank you.
Thank you.
Thank you.